Imagine having a roadmap that shows exactly where, trillions of global dollars are moving right this very second. Not just some lagging indicator or a historical chart, but a real-time diagnostic of the literal arteries of global capitalism. Today, for you, we are basically handing you that exact roadmap.
Right. It is the ultimate vantage point. We're taking a deep dive into the Q2 2026 earnings conference call of BlackRock. And to understand why this specific earnings call matters more than almost any other corporate event out there, we have to immediately address the sheer just gravity-distorting scale of this firm.
Yeah, the scale is wild. Welcome to Talk Tickers, by the way, where we break down these massive earnings calls for retail investors. Our style is data-forward, opinionated, and actionable. And the headline data point here, they just reported a record $15.3 trillion in assets under management.
Trillion, with a T, which is just, it's hard to even conceptualize.
Right. To put that into perspective for you trying to map that onto the real world, $15.3 trillion is essentially the entire gross domestic product of China. It's roughly equivalent to the combined market caps of Apple, Microsoft, Nvidia, Amazon, and Google, all sitting under one roof.
And when you control that much capital, you are no longer just a participant in the market. You're the infrastructure. Your quarterly earnings call, well, it ceases to be a typical corporate update about margins or product launches.
Yeah.
It becomes the definitive diagnostic on the health and the forward direction of the global economy.
Exactly. And the most vital metric on that diagnostic report right now is the velocity of capital movement. So looking at the story behind the numbers, just in the second quarter of 2026, a 90-day window, mind you, BlackRock generated $192 billion in net inflows.
Which is a staggering acceleration. If we pan out and look at the trailing 12 months, they've pulled in $868 billion.
Almost $1 trillion in 1 year.
Yeah, $1 trillion of newly entrusted capital, which drove their organic base fee growth to 10% over the last 12 months. We are witnessing this massive consolidation of global wealth into a single platform at a pace that is just historically unprecedented.
So our mission for this deep dive is to decode the Wall Street phrasing from this call, strip away the corporate polish, and extract the absolute most critical insights about where exactly that $868 billion is going.
We are going to rip into the mechanics of their public market engines, their massive push into physical private infrastructure, their AI tech stack, and ultimately this really aggressive move they're making onto the blockchain.
Right, but before we track where client money is flowing, we have to look under the hood of BlackRock itself. We need to examine how they're structurally altering their own profitability. Because honestly, the financial engineering happening on their own balance sheet right now is fascinating.
It really is.
I call it the margin machine. Let's look at the headline income statement. In Q2 of 2026, their revenue surged 31% year over year to $7.1 billion. Operating income jumped even higher, up 39% to nearly $2.9 billion.
And those are software company growth numbers. Those are not legacy financial institution numbers.
Right. But here is the discrepancy that immediately jumps off the page to me, and we need to unpack the mechanics of it. Their earnings per share, their EPS, hit $13.91. That is only a 15% increase year over year.
Which seems totally contradictory.
Yeah, if your operating income, the actual profit from running your core business, is up 39%, how does your EPS only climb 15%? The math feels broken there.
It looks broken on the surface, but it's actually a masterclass in how major M&A activity distorts short-term GAAP accounting. So the chief financial officer, Martin Small, he actually isolated this gap down to a few specific non-operational drags. First one being lower non-operating income.
Okay, let's break that down for the listener. Non-operating income for an asset manager usually means the return on their seed capital, right?
Yes, exactly.
Yeah.
BlackRock holds investments on its own balance sheet, often to, seed new funds before they open to the public, or they make strategic co-investments alongside their clients.
Got it.
So they recognized about $170 million in net investment gains this quarter, driven by equity method earnings and some non-cash valuation markups. But compared to the massive boom in their core fee revenue, this bucket was a comparative drag year over year. It just didn't keep pace.
So the side investments didn't grow as fast as the core fee engine. That makes sense. What was the second drag?
The tax man. Their as-adjusted effective tax rate was approximately 25% higher in this quarter compared to the prior year.
Oh, wow. A 25% relative increase.
Yeah. And when you're operating at a multi-billion-dollar scale, an increase like that in your effective tax rate acts as a massive compressor on the final net income that trickles down to the bottom line.
All right, but the third factor is the one I really want to dig into because I think it speaks to their aggressive expansion strategy, share dilution.
Yes, an increased weighted average share count.
And we all know the basic mechanics of dilution. If a company issues new shares, the denominator in the EPS equation gets larger, so the EPS shrinks, even if the total net income stays flat.
Right. But they didn't just issue shares for the fun of it.
No, they issued them to close one of the most significant acquisitions in their history.
The HPS acquisition. HPS is an absolute titan in the private credit space. BlackRock officially closed that massive transaction on July 1st, 2026.
Right.
And to fund an acquisition of that magnitude without completely depleting their cash reserves or, over leveraging their balance sheet with debt, they used their own publicly traded equity as currency. They issued new BlackRock shares to the partners and owners of HPS.
So in Q2, the existing shareholders are absorbing the mathematical dilution of those newly minted shares, but they haven't yet seen the full year benefit of HPS's cash flow actually hitting the income statement because it only closed on July 1st.
Exactly. It's a timing mismatch that creates this 39% versus 15% illusion.
That makes total sense. And it leads us directly into the debate over their operating margins, which is where I start to get a bit skeptical.
Okay, let's hear it.
So BlackRock expanded its operating margin by 260 basis points year over year to 45.9%. That is their highest operating margin in nearly 5 years. They generated a third of their total operating income in the first quarter alone.
Yeah, the profitability is immense.
But usually, when a massive corporation undertakes a multi-front, really aggressive expansion integrating a giant private credit firm like HPS, absorbing global infrastructure partners, buying data companies like Prequin, their operational costs skyrocket.
Because of integration costs, right?
Yeah. You have massive legal fees, redundant software systems to consolidate. Profit margins almost always take a beating during a scale-up phase. Think of it like running a restaurant. If you rapidly expand your menu to include high-end catering and a digital delivery app, your operational costs usually go through the roof initially.
Right. It's the classic J-curve of private equity and corporate expansion. Things get worse before they get better.
Exactly. So my pushback to management is this. Is a 45.9% margin actually a sustainable structural reality? Or is this just a lucky byproduct of global equity markets hitting all-time highs?
Because market beta just lifts their revenue automatically.
Right. We both know that if the S&P 500 goes up 15%, BlackRock gets a massive revenue raise without hiring a single new employee. So is this margin real or just a market high?
It's probably the most critical question an analyst can ask them right now. And management vigorously defended this 45.9% figure, not as a cyclical peak, but as a structural baseline going forward.
Okay, how do they justify that?
Well, they explicitly acknowledge the tailwind of higher markets obviously lift their average AUM and base fees, but they pointed to their fundamental revenue mix shift as the real driver here.
The 2030 goal they outlined at Investor Day.
Right. They've drawn a hard line in the sand. By 2030, they want over 30% of their total revenue to come from private markets and technology.
And we really need to dissect why those two specific categories are the holy grail for margins. Let's look at a public market index fund for contrast. BlackRock might charge, 3 or 4 basis points to manage an S&P 500 ETF?
Yeah, fractions of a percent. It's totally a volume game.
Right. It's profitable because they run trillions of dollars through it. But the gross margin per individual dollar is tiny.
Whereas in private markets, say, managing a private equity or private credit fund base fees are frequently 100 to 150 basis points, plus a percentage of the performance upside.
That's a huge difference.
And crucially, that capital is locked up. A client can't just hit sell on their E-Trade app and pull their money out of a 10-year infrastructure fund.
Right.
That creates incredibly sticky, high-margin, highly predictable revenue.
And the technology side is even better. I mean, it's pure software as a service.
Exactly. When they license their Aladdin risk software to an external pension fund, that is recurring high-margin subscription revenue that requires almost zero additional capital expenditure to maintain once the software is actually built.
So as private markets and technology become a larger percentage of the overall revenue pie, the blended corporate margin mathematically just has to rise.
That's the management thesis.
I understand the theory of the mix shift. But look, anyone can put a goal in a PowerPoint slide for 2030. What happens if we hit a severe credit event next year?
A fair point.
Private market valuations are notoriously opaque and arguably very inflated right now. If the denominator effect kicks in and institutional clients have to halt their private market allocations, doesn't that high margin revenue just vanish, taking the 45.9% margin right down with it?
It is a totally valid macro risk. If the music stops in private credit, BlackRock definitely feels it. But Martin Small used some historical context to shut down the idea that 45.9% is just an anomaly.
What did he point to?
He reminded the analysts that back in 2021, BlackRock was running the company at margins approaching 47%.
Wait, that was before the massive scale up in private markets, wasn't it?
Exactly. They achieved 47% before they integrated GIP and HPS. And here's the kicker. Before BlackRock acquired them, both GIP and HPS were operating as independent firms at margins north of 50%.
Oh, wow.
So mathematically, as you fold two 50% margin businesses into a 45% margin business, the overall corporate margin should accrete upwards, assuming they don't completely botch the integration.
Okay, so the margin machine has a solid structural defense. But a machine that efficient requires a continuous massive supply of raw material. It needs capital inflows, which forces us to look at where that $192 billion in Q2 actually came from.
And the answer overwhelmingly is the ETF juggernaut.
Yeah, of that $192 billion, $178 billion was pure net inflow into iShares ETFs. The scale of their dominance in the exchange-traded fund space is just hard to overstate.
Core equity ETFs pulled in $85 billion. Index bond ETFs grabbed another $61 billion.
But the numbers that genuinely surprised me were in the active space. Active ETFs pulled in $20 billion, which leads the entire industry for 2026 so far. And precision ETFs, which we'll define in a second, added another $15 billion.
We're basically witnessing a fundamental evolution in how the financial industry views the ETF.
We really need to break down the mechanics here for our Talk Tickers audience, because I think a lot of people still view ETFs through a pretty outdated lens. Historically, the ETF was just a passive tracker.
Right, the classic cap-weighted index fund. It was the ultimate set it and forget it tool for retail investors.
Yeah, you bought SPY or IVV, it tracked the 500 largest US companies, and you paid basically nothing for it. It was the vanilla ice cream of investing. Cheap, passive, boring. But BlackRock is proving that the ETF isn't an investment strategy in itself, it is merely a wrapper.
It's a delivery technology.
Exactly. It's like turning a basic commuter car into a highly customizable sports car. And for decades, the mutual fund was the dominant delivery technology for active management. If you wanted a brilliant portfolio manager handpicking stocks, you bought a mutual fund.
But mutual funds have a massive fatal flaw when it comes to taxes.
The capital gains distribution problem. Let's walk through the mechanics of this, because it totally explains why $20 billion just flooded into BlackRock's active ETFs.
Sure, go for it.
So if you own a mutual fund and 1,000 other investors suddenly decide to sell their shares and cash out, the portfolio manager has to sell underlying stocks to raise the cash to pay those departing investors.
Right.
When the manager sells those stocks at a profit, it triggers a capital gains tax.
Right.
And by law, that tax burden is passed on to everyone who is still holding the mutual fund.
It is deeply unfair. I mean, you could buy a mutual fund in November, not sell a single share, and get hit with a massive tax bill in December simply because other people decided to panic sell and cash out.
But the ETF wrapper completely circumvents this through a mechanical process called in-kind redemptions. I like to think of it like a barter system orchestrated by an authorized participant, or an AP.
Walk us through that barter system. How does it work?
Okay, so if heavy selling pressure hits an ETF, the ETF provider doesn't have to sell the underlying Apple and Microsoft shares to raise cash. Instead, the authorized participant, usually big Wall Street bank, steps in.
Right.
The AP buys the ETF shares from the sellers on the open market, hands those ETF shares back to BlackRock, and BlackRock simply hands the AP a basket of the underlying stocks in exchange.
So it's a direct swap, shares for shares.
Precisely. No cash changes hands between the fund and the AP. Therefore, no taxable sale is triggered inside the fund. The investors who are holding the ETF long-term are completely shielded from the capital gains taxes generated by the people who are panic selling.
It is a structurally superior, highly tax-efficient delivery vehicle.
And BlackRock's masterstroke was realizing that there's no law saying you can only put passive indexes inside the superior wrapper. They looked at the landscape and said, let's take our best, most aggressive, alpha-seeking human portfolio managers, and let's put their strategies inside the ETF technology.
So investors get the active outperformance they want, but with intraday liquidity and zero surprise tax bills at the end of the year.
Which explains how they vaulted from being the 7th largest active ETF manager to the 3rd largest in just 36 months. They're literally cannibalizing the legacy mutual fund industry from the inside out.
And they are doing it with precision ETFs as well, which brought in that $15 billion you mentioned.
Let's define that. What exactly makes an ETF precision?
Precision ETFs are hyper-targeted instruments. If a wealth manager believes that, say, European healthcare is undervalued or that Taiwanese semiconductor manufacturers are about to surge, they don't want a broad international fund that dilutes that specific thesis.
They want a scalpel, not a sledgehammer.
Exactly. They want a precision tool, an ETF that holds only European healthcare companies. It allows financial advisors to actively build highly customized tactical portfolios for their clients using passive components.
Speaking of Europe, the geographic breakdown of these inflows reveals a massive cultural shift. This is no longer just an American phenomenon. iShares raised $80 billion in Europe year to date, crossing $1.5 trillion in total European AUM.
The CEO, Larry Fink, spent significant time on the call discussing what he termed the democratization of investing across Europe and Asia.
We really have to contextualize how profound a shift this is. Historically, the European retail investor has been incredibly conservative compared to the American retail investor. Americans have 401ks, IRAs, Robinhood accounts. We are equity obsessed.
But European households have traditionally kept a vastly larger percentage of their net worth sitting in cash in traditional bank savings accounts.
Right, because the social safety nets in Europe, state-funded pensions and healthcare, historically reduced the personal imperative to generate aggressive market returns to fund their retirement.
But that math is breaking down.
Yeah, inflation is eroding those cash deposits. And state pensions are under pressure from demographic aging. Europeans are waking up to the reality that cash is a melting ice cube. They have to move out on the risk curve.
And as they make that transition from bank depositors to capital market investors, BlackRock is basically the primary toll collector. But there is a fascinating nuance to what they are buying. Fink referred to it as the nationalization of investing.
Unpack that, because for the last decade, global investing basically meant buying U.S. tech stocks, right?
Exactly. For years, if you were a German or Japanese investor seeking growth, you disproportionately allocated capital to U.S. dollar-denominated assets. You bought the S&P 500 because American tech monopolies were the only game in town.
Makes sense.
But BlackRock is seeing a stark reversal. European investors are increasingly using iShares to buy European equities. Asian investors who pushed locally domiciled iShares in APAC over the $100 billion mark this quarter are buying Asian markets.
Why the sudden home country bias?
Part of it is geopolitical fragmentation. People want capital insulated within their own regulatory jurisdictions, but it's also believed that the massive valuation gap between U.S. equities and the rest of the world has stretched too far, and local markets present better yield and value.
So they're using BlackRock's infrastructure to participate in the growth of their own backyards. But this massive global distribution network brings us to the most contentious part of the public markets discussion, the distribution power play, the fight over the tolls.
This is a critical structural dynamic in the wealth management industry right now.
Let's set the stage for the listener. BlackRock manufactures the financial product, the ETF, but they don't interact directly with the mom-and-pop investor. The retail investor logs into Charles Schwab or Fidelity or calls their Merrill Lynch advisor. Those brokerages are the gatekeepers.
They own the shelf space.
And recently, the gatekeepers have realized the immense power they hold. Platforms like Schwab have been steadily increasing the pressure on asset managers, demanding higher platform fees or revenue-sharing agreements.
Essentially, they're saying, if you want your ETF to be available for our millions of retail clients to buy, you have to pay us a toll for the shelf space.
It's the exact same dynamic as a massive grocery store chain demanding slotting fees from a cereal brand to put their boxes at eye level. So on the call, an analyst from Autonomous Research directly challenged BlackRock on this.
Right. He pointed out these rising tolls and asked if this was going to eat into BlackRock's revenue.
And BlackRock's response was, well, it was a polite corporate version of a mic drop.
It was a fascinating assertion of leverage. Martin Small stated unequivocally that BlackRock's index ETF distribution philosophy does not include paying tolls.
They are not in active negotiations to pay platform fees on broad index ETFs, period. But I have to challenge the mechanics of how they actually enforce that.
How so?
If a platform with $8 trillion in client assets like Schwab comes to you and says, pay the toll, how does BlackRock simply say no without getting their funds delisted?
Because of the holistic ecosystem BlackRock provides to those platforms. If BlackRock were just a vendor selling a single S&P 500 fund, Schwab would delist them in a heartbeat and replace them with a Vanguard or State Street fund.
Sure.
But BlackRock doesn't just provide the ETF, they provide Aladdin wealth technology,
which is the risk management software that thousands of financial advisors on those exact platforms use every single day to build client portfolios.
Exactly. BlackRock also provides pre-built model portfolios. They provide institutional-grade macro research. They are essentially embedding themselves into the operational workflow of the brokerage itself.
So if a brokerage threatened to kick iShares off the platform, they wouldn't just be losing a ticker symbol, they'd be breaking the software and portfolio models that their own financial advisors rely on to do their jobs.
Plus, there is a brand reputation risk for the brokerage. iShares is the most liquid, recognized ETF brand on earth.
Right. If a retail client logs into their account and searches for the iShares Gold Trust, and a message pops up saying, this asset is no longer supported on our platform, that client doesn't blame BlackRock.
No, they get frustrated with the brokerage and move their entire account elsewhere.
So BlackRock has achieved a scale where they are immune to traditional distribution extortion. They aren't a tenant paying rent to the brokerages. They are a structural partner that the brokerages literally cannot function without.
Okay, so they have completely fortified their dominance in the digital ticker tape world of public markets. They have the wrapper, they have the active alpha, they have the global distribution, and they don't pay tolls.
But public equities are only half of the global economy, and BlackRock knows that. Which brings us to the most aggressive pivot in the company's recent history, the physical world.
The private market flywheel. This is where we move from trading digital shares of companies to funding the actual concrete, steel, and fiber optic cables that run the planet.
The inflows here are gaining massive momentum. In Q2, they recorded $15 billion in net inflows into private capital. That was anchored by $6 billion into private credit and $5 billion into infrastructure.
And crucially, they noted another $22 billion in closed and notified fundraising that hasn't even hit the fee-paying AUM yet.
This represents a fundamental evolution in what BlackRock actually is. I look at their recent acquisitions, and the analogy that crystallizes this for me is that BlackRock is building itself into the ultimate general contractor for global capitalism.
Walk us through the mechanics of that general contractor model.
Okay, let's look at the most capital-intensive sector on Earth right now, artificial intelligence. The hyperscalers, Amazon, Microsoft, Google, are in an arms race to build massive AI data centers.
Right, and these aren't just big warehouses.
No, these are facilities that require dedicated nuclear power plants or massive solar arrays just to keep the servers cool. They cost tens of billions of dollars apiece.
The capital requirements are straining even the largest corporate balance sheets.
Exactly. Historically, if a tech giant wanted to build a $20 billion project, they had a miserable administrative process ahead of them. They had to hire a Wall Street investment bank to syndicate the debt across dozens of lenders.
They'd have to go to a specialized private equity firm to find mezzanine financing.
Yeah, and find a real estate firm to secure the land and power rights. It was a fragmented, highly frictional process.
But the ultimate general contractor steps in and eliminates the friction.
Right. BlackRock can now walk into the boardroom of a hyperscaler and say, give us the blueprints, we will provide the entire capital stack.
How do they do that?
Through their acquisition of global infrastructure, partners GIP BlackRock can provide the multi-billion-dollar equity layer and operational expertise to actually build the physical facility. And through their acquisition of HPS, BlackRock can originate and syndicate the massive private credit debt layer required to leverage the project.
One phone call, one partner, total execution.
And we saw the exact prototype of this general contractor model announced on the call. They highlighted the Aligned Data Centers deal.
This was a fascinating transaction. Let's unpack the alphabet soup of entities involved in this, because it really shows the sheer networking power BlackRock wields.
The deal brought together AIP, GIP, and MGX to build one of the most sophisticated AI data centers in the world. Okay, what are those entities?
Well, AIP is Alternative Investment Partners, a specialized unit within BlackRock that handles custom alternative solutions. GIP is Global Infrastructure Partners, the massive infrastructure firm BlackRock is acquiring, which brings the engineering and physical asset management expertise.
And MGX?
MGX is a newly formed technology investment company out of Abu Dhabi, backed by sovereign wealth, specifically designed to accelerate AI infrastructure globally.
So BlackRock is acting as the central nervous system, connecting sovereign wealth from the Middle East with internal alternative capital, with world-class infrastructure operators, all to build the physical backbone of AI.
And that is just the equity side. The debt side of the private market flywheel is arguably even more powerful, and it hinges on private credit.
This is where I have to throw up a red flag and push back on the narrative for our listeners. Because as opinionated hosts, we have to look at the risks.
Sure.
We have been reading nonstop warnings from financial regulators about the systemic risks brewing in private credit. Because these loans are negotiated privately between a company and a lender like HPS, they don't trade on a public exchange. There is no daily price discovery.
That's true.
If a borrower starts defaulting, the broader market doesn't see it until it's too late. With interest rates staying higher for longer, aren't institutional clients terrified of pouring billions into illiquid, opaque debt? I mean, it sounds incredibly risky.
It is the defining risk of the asset class. But to understand why the inflows continue despite those macro fears, you have to look at the mechanics of who is actually buying this debt from BlackRock. It's not day traders, it's insurance companies.
Why are insurance companies the apex predators of private credit?
It all comes down to the brutal mathematics of liability matching. When a life insurance company writes a policy today, they are collecting a premium in cash, and in return, they are taking on a legally binding liability to pay out a death benefit in 20, 30, or 40 years.
They have incredibly long duration, highly predictable liabilities. They know actuarially almost exactly when they'll need the money.
Precisely. Now, how do they make a profit? They have to invest those premiums today in an asset that yields a guaranteed return that is higher than the eventual payout. Historically, they just bought 30-year U.S. Treasury bonds.
But for the last decade, Treasury yields were incredibly low, making it difficult for insurers to meet their actuarial return targets.
Enter private credit. Private credit offers a structural solution, the illiquidity premium.
Break that down.
If a mid-sized software company needs a $500 million loan, they could try to issue public junk bonds, but that is highly regulated and slow. Or they can go to BlackRock's HPS and get a bespoke, flexible private loan.
But because BlackRock and the insurance company cannot easily sell that loan to someone else tomorrow, because it is illiquid, they demand the borrower pay a higher interest rate.
The call noted that insurance companies can earn a 150 to 350 basis point premium over comparable public bonds by investing in this high-grade private debt.
Think about the compounding math of that. An extra 1.5% to 3.5% yield every single year, compounded over a 20-year liability timeline. It is a staggering amount of excess capital.
And because the insurance company mathematically knows they won't need to sell the asset for 20 years, the lack of daily liquidity doesn't bother them at all. They are the perfect buyer for illiquid debt.
Which perfectly explains the stat from the call. BlackRock secured $10 billion in high-grade debt mandates, specifically from insurance companies, just in the first half of 2026. The risk of illiquidity is a bug for a retail investor, but it is a highly profitable feature for a life insurer.
And this scale is leading to a massive consolidation wave. Institutional limited partners, like massive pension funds or sovereign wealth funds, are exhausted by the fragmentation of the industry.
Like the $3 billion Latin American mandate they mentioned on the call.
Exactly. Imagine you are the chief investment officer of a massive Latin American pension fund. Over the last 20 years, you have allocated capital to 50 different private equity funds, 30 different private credit managers, and a dozen real estate operators.
The administrative burden of tracking all those capital calls, distributions, and K-1 tax documents must be an absolute nightmare.
It is highly inefficient, and it dilutes your negotiating power on fees. So what are LPs doing? They are consolidating. This Latin American pension fund took a $3 billion portfolio of scattered private market investments and handed the keys entirely to BlackRock's private equity solutions group.
They essentially outsourced the management of their external managers. They told BlackRock, you rationalize this portfolio, you track the data, you optimize the returns.
But this raises a profound logistical question. If you are BlackRock, how do you actually execute this?
Yeah, how do you simultaneously manage a $3 billion private equity portfolio in Latin America, structure the debt for an AI data center in Texas, and instantly process a $20 shares ETF trade for a retail investor in Germany?
Human beings and Excel spreadsheets cannot process that volume of complex cross-asset data.
Which brings us to the invisible engine powering the entire firm, the technology stack. The financials here are robust. Technology annual contract value, or ACV, grew 15% year over year, with total revenue up 13%.
And management reiterated their confidence in sustaining low to mid-teens ACV growth over the long term.
So I have to ask the question that constantly circles this company. Is BlackRock fundamentally a Wall Street asset manager, or are they secretly an enterprise software company wrapped in a financial trench coat?
Increasingly, they are the latter. The software is what makes the asset management possible at this scale.
Let's focus on their systematic equities platform, because the numbers here are staggering, and they speak directly to the man versus machine dynamic on Wall Street.
The growth is explosive.
Systematic equities doubled in assets under management to $400 billion in just 2 years. They brought in $20 billion in net inflows just this quarter.
For context, $400 billion is larger than the GDP of many developed nations, and it is being actively managed not by a room full of guys in suspenders screaming at Bloomberg terminals, but by algorithms.
I really want to break down the mechanics of how this works. The source material states they use over 1,000 distinct alpha signals. What exactly is an alpha signal, mechanically speaking?
An alpha signal is a mathematically quantifiable piece of data that historically correlates with a stock's future outperformance.
Give me a tangible example.
Historically, an alpha signal might have been purely fundamental. If a company's price-to-earnings ratio drops below 10 and their free cash flow yield is above 8%, buy the stock. But today, systematic equities run on massive alternative data sets parsed by artificial intelligence and natural language processing.
So they're basically reading the matrix.
Literally.
Yeah.
An alpha signal could be a natural language algorithm that instantly reads the supply chain manifests of a semiconductor company, cross-references it against real-time satellite imagery of shipping container pileups at the Port of Long Beach.
Wow.
And determines within milliseconds that the company is going to miss their quarterly revenue targets due to logistical bottlenecks. The algorithm shorts the stock before a human analyst has even finished reading the first paragraph of the shipping report.
Or tracking the anonymized credit card data of 1 million consumers to predict a retailer's earnings beat before they announce it.
Exactly. They have thousands of these micro signals constantly firing, and AI optimization engines dynamically allocate capital across them to manage risk and exploit microscopic market inefficiencies.
And you cannot argue with the results. Over 90% of their systematic equity AUM beat its peers or benchmarks over the 3- and 5-year periods. 90% outperformance is almost statistically impossible for traditional human stock picking.
Which is why institutional capital is flooding into the systematic platform. But BlackRock's technology ambitions extend far beyond just beating the S&P 500.
They want to own the whole system.
Right. They are building the definitive operating system for the entire wealth management industry. And to understand this, we have to look at the holy trinity of their tech stack: Aladdin, eFront, and Prequin.
Let's define the roles of these three systems, because this is where public and private markets collide. What's Aladdin?
Aladdin is the foundational bedrock. It was originally built internally by BlackRock decades ago to manage their own bond risk. They eventually realized the software was so good they could lease it out as a SaaS product. Today, Aladdin is the premier central nervous system for public market risk and portfolio management globally.
Okay, so Aladdin handles the stocks and the bonds, but what about the illiquid stuff? The private credit and the infrastructure?
That is where eFront comes in. BlackRock acquired eFront a few years ago to serve as the analytical engine and administrative backbone specifically for alternative investments.
And Prequin, the massive acquisition they just announced.
Prequin is the ultimate data layer. Private markets are famously opaque. There's no consolidated tape, no centralized ticker feed for private equity valuations. Prequin spent decades building the most comprehensive proprietary database of private market performance, fund terms, and valuation metrics in the world.
So if you bolt Prequin's data into eFront's analytics and integrate all of that into Aladdin's public market risk engine,
you achieve the holy grail of modern finance, a single, unified technology dashboard that allows an investor to look at a holistic portfolio, say, Apple stock, a portfolio of U.S. Treasuries, and a private loan to a regional hospital system, and instantly calculate the correlated risk across all of it in real time.
And the regulatory environment is practically forcing the industry to adopt this technology. The source material specifically highlighted the Department of Labor's safe harbor rules.
This is a critical driver for tech adoption.
Tell us about those rules.
The Department of Labor governs the fiduciary standards for retirement accounts in the United States, primarily 401ks. Historically, 401ks only held liquid public mutual funds. But the industry desperately wants to introduce private assets, like private credit or real estate, into defined contribution plans to boost returns and diversification.
But the DOL says, if you put grandma's retirement money into an illiquid private equity fund, you better be able to prove, mathematically and transparently, that you are upholding your fiduciary duty.
Exactly. You cannot just rely on a quarterly PDF report from a private manager saying, trust us, the asset is doing great.
Right.
The DOL requires rigorous benchmarking, daily valuation approximations, and absolute transparency. The only way a 401k plan administrator can legally justify including private assets is if they have a technology system capable of proving the risk metrics to the regulators.
And BlackRock is positioning Aladdin to be that mandatory compliance and risk engine for the entire industry. It is a brilliant moat. If you want to play in the high-yield private markets, you have to pay the toll to use BlackRock software to keep the regulators off your back.
It creates incredibly sticky structural revenue.
But this massive computational power isn't just reserved for multi-billion-dollar pension funds fighting with the Department of Labor. BlackRock is aiming this technology directly at the individual wealth of mass affluent investors, which takes us into the realm of hyper-personalization and the concept of tax alpha.
This is perhaps the most immediate disruption to the traditional wealth management model.
The star players here are Appirio and SpiderRock. Appirio is a platform that provides highly customized direct indexing. Its AUM is approaching $200 billion. It has grown 4x in just 5 years, bringing in $7 billion in net inflows this quarter alone.
And SpiderRock, which handles custom options overlays, is following a similar trajectory, tripling its AUM to $13 billion in 2 years.
To understand why Appirio is capturing so much capital, we have to contrast direct indexing with the traditional ETF wrapper we discussed earlier.
Okay, let's do it. If the ETF is structurally superior to a mutual fund because it shields you from capital gains taxes, what is the flaw with the ETF?
The flaw with an ETF is that it is a commingled, standardized product. If you buy an S&P 500 ETF, you own a tiny fractional slice of all 500 companies, but you don't actually own the underlying shares directly. The ETF provider does.
That means you cannot customize it.
Right. You can't customize it based on your personal ethics or your tax situation. If you work for Chevron and a massive portion of your net worth is tied up in Chevron company stock, buying an S&P 500 ETF means you are accidentally buying more Chevron, increasing your concentration risk.
You can't just strip it out.
Exactly. But Appirio uses computational power to execute direct indexing at scale. Instead of buying one ticker symbol, Appirio's software logs into your brokerage account and systematically purchases the individual underlying 500 stocks in the exact weights of the index, but it does it directly in your name.
So you actually own the Apple, the Microsoft, the Tesla shares.
Yes. And because you own the individual components, you can apply hyper-personalized filters.
Like what?
You can tell Appirio, replicate the return of the S&P 500, but strip out all fossil fuel companies and strip out Chevron specifically because I already have too much exposure.
And just to be clear for our listeners, we aren't taking a stance on ESG or fossil fuels here. We're just explaining the mechanics of the software based on the source material.
Right. It's just a functional capability. The software dynamically recalculates the weights of the remaining 450 stocks to ensure your portfolio still tracks the broader market return despite the emissions.
That is the customization layer. But the real explosive growth of Appirio isn't about ESG filters. It's about tax alpha.
Tax loss harvesting. This is where the math gets incredibly powerful. I want to use an analogy here to explain the mechanics of how direct indexing generates tax alpha. Forget the typical Wall Street analogies. I want you to think of a traditional ETF as a single, massive oak tree. If lightning strikes the tree, the whole tree is damaged. You can't just chop out the bad part and pretend it didn't happen.
Okay, I follow.
But direct indexing is like owning a massive commercial farm with 500 different fields growing different crops. The overall goal of the farm is to be profitable. But we know that in any given year, there will be localized droughts or pest infestations. So 50 of your fields suffer a total crop failure, while the other 450 fields produce a bumper crop.
Right, market dispersion. Even in a bull market, some stocks go down.
Exactly. A smart commercial farmer doesn't just ignore the dead fields, they plow the dead crops under, declare a massive agricultural loss for those specific fields to the IRS to get a tax write-off, and then immediately plant a highly correlated substitute crop in that same soil to ensure they still get a harvest next season.
And that is exactly what Appirio software is doing with your stocks every single day.
Break down the exact mechanical execution of that trade.
Let's say the overall S&P 500 is up 10% for the year, but Home Depot stock is down 15%. Because Appirio holds the individual stocks in your account, their algorithm detects that localized loss. It automatically sells your Home Depot shares, booking a capital loss on paper.
But wait, if they sell Home Depot, your portfolio no longer tracks the index accurately. And there's a rule, the wash sale rule, that prevents you from legally buying Home Depot back for 30 days if you want to claim the tax loss.
Exactly. And this is where the algorithmic brilliance comes in. Appirio doesn't just sit in cash for 30 days. The instant it sells Home Depot to book the loss, it simultaneously buys shares of Lowe's. Lowe's operates in the exact same sector with highly correlated beta, ensuring your portfolio maintains its structural exposure to the home improvement market while legally securing the tax write-off from Home Depot.
And the software is executing these paired trades across hundreds of positions, constantly scanning for localized losses to harvest, all while minimizing tracking error to the main index.
And why does this matter? Why is BlackRock management calling this a structural growth theme? Because, as Mark Andreas noted on the call, clients do not pay for their real lives with asset class level returns.
You cannot pay your mortgage with a pre-tax spreadsheet.
Exactly. You pay for life with after-tax dollars. If you make 10% in the market, but surrender 40% of those gains in short-term capital gains taxes, your real-world wealth accumulation is severely impaired.
Appirio systematically optimizes the frictional costs of reality. And if we connect this back to the private markets discussion, it becomes a holistic, firm-wide strategy.
How so?
Imagine a high net worth client who just received a massive, highly taxable distribution from a BlackRock private credit fund.
They have a massive tax liability looming.
Yes. BlackRock can deploy Appirio's long-short tax harvesting strategies in the client's public equity portfolio to aggressively generate offsettable capital losses. The public side of the portfolio acts as a bespoke tax shield for the massive gains generated on the private side.
It is a completely integrated, whole portfolio defensive ecosystem.
That is financial engineering at its absolute peak. They are weaponizing volatility to lower the tax bill.
And traditionally, managing a portfolio with that level of daily transactional complexity was a luxury service reserved for ultra-high net worth individuals with family offices.
But BlackRock's computational scale is democratizing it. They are delivering this capability to mass affluent investors through separately managed accounts, or SMAs, deployed by regular financial advisors.
Okay, we have covered the massive expanse of their current empire. The EPF, public dominance, the physical private infrastructure, the risk management software, and the tax optimization engines.
But there is one final frontier discussed on this call, and it represents the most futuristic and, frankly, the most disruptive part of this entire deep dive.
We are talking about the digital wallet spear tip. Tokenization and digital assets.
The stats here are deeply surprising for a legacy, heavily regulated Wall Street behemoth. BlackRock has $110 billion in AUM directly connected to digital assets. They have explicitly stated their goal to make this a $500 million revenue business by 2030.
Furthermore, they currently manage $60 billion in reserve assets for Circle.
Circle is the issuer of USDC, which is one of the foundational fiat-backed stablecoins in the decentralized finance or DeFi ecosystem. Managing $60 billion means BlackRock controls the underlying treasury bonds that back roughly a quarter of the entire global stablecoin market.
This presents a massive structural paradox that I think we need to aggressively push back on.
Let's look at the genesis of crypto. The original cypherpunks who coded Bitcoin, the architects of decentralized finance, their explicit philosophical goal was to bypass the traditional financial giants. They wanted a trustless system that didn't rely on the BlackRocks or the JP Morgan Chases of the world to custody assets or clear transactions.
The ethos of DeFi was absolute disintermediation of TradFi traditional finance.
Right. So now the biggest apex predator in TradFi is stomping right onto the blockchain. My question is, why would the crypto-native ecosystem accept them? Are the 5 billion people globally who have digital wallets on their phones really going to use this decentralized, futuristic technology just to buy a traditional legacy money market fund managed by Larry Fink?
It is the ultimate irony of crypto adoption. The purists desperately wanted to bypass TradFi, but they slammed into the wall of mass adoption. To get a billion people using digital assets, you need the regulatory compliance, the institutional trust, and the deep liquid plumbing that only TradFi possesses.
So they need BlackRock.
Yes. BlackRock isn't invading the blockchain. They are building the critical bridge between the two ecosystems because institutional clients are demanding it.
Let's break down the mechanics of that bridge, because the friction between the fiat world and the crypto world is currently miserable.
Miserable is an understatement. Think about the current mechanics of off-ramping. Let's say you hold a significant amount of wealth in Ethereum or Bitcoin in a digital wallet. You look at the macro environment and you decide you want to de-risk. You want to move your wealth into a safe, yield-bearing U.S. Treasury bond.
Under the current system, that is a multi-day administrative nightmare.
Exactly. First, you have to sell your crypto on an exchange, incurring trading fees and bid-ask spread costs. Then, you have to initiate a wire transfer or an ACH withdrawal to move that fiat cash back to your traditional bank account, which can take anywhere from T+1 to T+3 days to settle, assuming the bank doesn't flag the crypto transaction for compliance review.
It's a huge headache.
Once the cash finally clears your bank, you have to log into your traditional brokerage account like Fidelity or Schwab and execute a purchase of a treasury bond or money market fund.
It is slow, it is expensive, it triggers taxable events, and it completely removes you from the programmable digital ecosystem.
Now compare that friction to BlackRock's vision for tokenization. On the earnings call, they discussed 2 recent SEC filings for tokenized money market funds on the Ethereum blockchain.
Wow, on Ethereum.
Yeah, one is a tokenized share class of an existing traditional fund, and the other is a natively digital strategy designed specifically for the blockchain.
Natively digital, meaning it incorporates smart contract features like daily dividend reinvestment directly on chain.
Precisely. If BlackRock launches a tokenized treasury fund on Ethereum, that investor who wants to de-risk never has to leave their digital wallet. They don't have to touch a traditional bank or a legacy brokerage.
They just swap.
Exactly. Utilizing a decentralized exchange or an institutional platform, they simply execute a smart contract swap.
Right.
They exchange their volatile crypto asset for BlackRock's tokenized treasury fund. The settlement is instantaneous, executing in seconds rather than days.
And it operates 365 days a year outside of traditional banking hours.
And the mechanism facilitating the cash leg of these instantaneous subscriptions and redemptions is the stablecoin infrastructure.
Right. Which is why their partnership managing $60 billion in reserves for Circle's USDC is so strategic. They are building an ecosystem where third parties support stablecoin-enabled transactions, allowing institutional capital to flow seamlessly between high-risk digital assets and high-quality reserve liquidity, entirely on-chain.
And the data suggests this integration is working. The call highlighted the resiliency of digital asset demand. During a recent period of extreme volatility where core crypto prices dropped 30%, BlackRock's European Bitcoin ETF didn't see massive redemptions. In fact, it saw over $650 million in net inflows.
That is a critical behavioral data point. It proves that institutional and wealth management investors are no longer just treating digital assets as a speculative casino where they panic sell at the first sign of a drawdown.
They're treating it like a standard long-term portfolio diversifier.
Exactly. They are making calculated 1% or 2% strategic allocations, rebalancing when the price drops, just like they would with gold or emerging market equities.
And Martin Small framed this tokenization initiative perfectly. He didn't frame it as a tech gimmick. He called it the spear tip into an entirely new distribution channel.
Because it bypasses the gatekeepers.
Absolutely. It is a pure organic growth play. There are over $2 trillion in assets sitting in crypto wallets globally and another $300 billion sitting in stablecoins. This is a massive pool of capital that is currently isolated from traditional yield.
These are potential net new investors for iShares. They are potential users of BlackRock's model portfolios and tax-managed SMAs, all delivered in a tokenized, programmable format directly to a smartphone anywhere on Earth.
BlackRock is positioning itself to be the definitive digital wallet native asset manager.
Which brings us to the ultimate synthesis of this entire diagnostic roadmap. When we step back and look at the totality of what we have just broken down over this deep dive.
The overarching narrative is profound structural transformation.
Exactly. When you look at the J-curve defiance of their 45.9% margins, the tax-shielding mechanics of their $20 billion active ETF flows, the sovereign wealth coordination of the Alliant Data Centers deal, the algorithmic supremacy of Aladdin, the commercial farm tax harvesting of Appirio, and finally, the instantaneous on-chain settlement of tokenized Ethereum funds.
The reality becomes undeniable.
Yeah. BlackRock is no longer just a firm that picks stocks or tracks indexes. They are transcending traditional asset management.
They are methodically building the foundational operating system of global capital.
They are constructing the financial plumbing, the risk software, and the literal physical infrastructure of the future economy. Whether you are a retail investor in Germany realizing that bank deposits won't fund your retirement, a hyperscaler tech CEO trying to finance a 5-gigawatt AI server farm, an insurance actuary desperate for a 20-year illiquidity premium, or a digital native in South America holding USDC in a crypto wallet.
BlackRock's infrastructure is designed to process, manage, and extract a margin from your money.
They are positioning themselves at every critical junction of the value chain. As hosts of Talk Tickers, looking at the bottom line, this is an incredibly bullish signal on their structural resilience, even if macroeconomic headwinds arise.
Definitely a bullish structural setup.
Which leaves me with a final, highly provocative thought for you, the listener, to mull over as we wrap up. Something that builds on the mechanical realities of that last point on tokenization.
Let's hear the theory.
We talked extensively about the distribution power play earlier. We talked about how traditional brokerages and banks, the Schwabs, the Merrills are the gatekeepers demanding higher tolls and platform fees for shelf space.
Right.
But if BlackRock succeeds in its ultimate vision, if they tokenize their ETFs, their private equity funds, and their treasury reserves, and if they distribute those programmable tokens directly into the 5 billion digital wallets sitting on smartphones globally via seamless stablecoin integration,
they completely remove the mechanical friction of the traditional brokerage account.
Exactly. The intermediary is engineered out of the process. So the lingering question is this. Do the massive traditional banks and brokerages, the ones currently flexing their muscles and demanding tolls today, do they even realize they are slowly, methodically being bypassed by the very firm that supplies their products?
Are we watching the ultimate technological disintermediation of Wall Street, orchestrated from the inside by the ultimate general contractor?
It is a phenomenal question. If the real-time X-ray of global capital shows money moving directly from BlackRock's on-chain smart contracts straight to your personal digital wallet, a lot of highly paid middlemen in the traditional financial sector are going to wake up and find themselves structurally irrelevant.
That's a huge shift.
And suddenly, that roadmap of global finance we promised at the beginning, it points unequivocally to one destination: the operating system. Thank you for joining us on this deep dive. We'll see you next time on Talk Tickers.